we propose to understand the tax mysteries around the word shares under the provisions of Income Tax Act. The question therefore is, what is then the meaning of shares? If you are a non-resident and are investing from a tax treaty country, then you have got a unique advantage. You can avail the benefits under the double tax avoidance agreement. This podcast is more beneficial for non-resident investing in India. This mutual fund is covered within the term shares or not. Those are not shares as defined under the provisions of Companies Act. Those do not fall within the catch-all provisions and are excluded. Therefore, you go to the residuary provisions of the tax treaty, and most of the residuary provision which says that if it is property other than shares and does not cover instruments like compulsorily convertible debentures and derivatives. Dear friends and esteemed professional colleagues, aren't we surrounded by noises? Noises of social media. Endless conversations on WhatsApp group and breaking news of what? Tax decisions and legislative changes. Add to this are our traditional problems: skilled manpower, growing working hours and low billable hours. We at BGSS decided to step back and answer one important question: what truly inspires us? The answer was knowledge and effortless research. We reawakened the chartered accountant within us, who was freshly qualified, who attended various study circles, made every notes when legends delivered, and a little bit within ourselves where we used to pray to the God that may their own brilliance be imbibed within us. With this, we propose to chartered on the journey of knowledge and innovativeness. Have you ever thought of a world where we have a population of 8 billion? Each people have distinct fingerprint, distinct iris, and different voice modulations. If Almighty can champion this art of innovativeness, can't we imbibe a little bit from Him and deliver something new, something different? With these thoughts, we are pleased to present before you our first podcast of what we call to be Third Eye by BGSS. In this podcast, we propose to understand the tax mysteries around the word shares under the provisions of Income Tax Act. This podcast is more beneficial for non-resident investing in India. Under the provisions of Income Tax Act, entire income is taxable. However, if you are a non-resident and are investing from a tax treaty country, then you have got a unique advantage. You can avail the benefits under the double tax avoidance agreement. If certain relaxations are given under DTAA, it may potentially reduce your tax liabilities. A typical instruments like shares, mutual funds, debentures, derivatives are governed by the capital gains article under the DTAA. Essentially, DTAA provides distributive rights between two countries. A traditional DTAA, let's take for a case, a India-Mauritius tax treaty reads, and this is the amended treaty which applies from 1st April 2017, which typically reads, gains from alienation of shares acquired on or after 1st April 2017 in a company which is resident of a contracting state may be taxed in that state. If it is not shares, then the residuary article comes into the picture, which says gains from alienation of any property other than that referred to in above, which typically covers movable property, immovable property and shares, would be taxable in the state of residence, that means Mauritius. Now this gives rise to certain questions as to what is then the meaning of this term shares. Is it that anything other than share is not taxable in India and therefore is taxable in the state of residence? Shares per se are not defined under the provisions of Income Tax Act. The cardinal principle is that if a term is not defined under the Income Tax Act, then you go and look at the definitions under the Ancillary Act. In this case, the nearest act which comes is the provisions of Companies Act 2013, which defines shares to mean a share in share capital of a company and includes a stock. The question therefore is, what is then the meaning of shares? To me, shares is all-encompassing, will cover traditional instruments like an equity instrument, even shares with a differential voting rights, say right to have accelerated voting, rights to have higher dividend, or DVR, shares with a differential voting right, all would be covered within the meaning of shares. Meaning thereby that if you as non-residents transfer that particular share, India has a right to tax, treaty does not relieve you. Similar would be the situation in case of preference shares. Preference shares may cover CCPS, a cumulative compulsorily convertible preference share, and optionally convertible preference shares. Even in those cases, if those instruments are transferred, whether to a resident or to a non-resident, it would still fall within the meaning of term shares, and most of the treaty, India has a taxing right. Interesting situation develops when we look at different instruments. Let us look at mutual fund. Now, all of us are aware that mutual fund is buoyant as an instrument to invest in India. Essentially, mutual funds are governed by the SEBI provisions, where it is the trust which issues its own unit, and the trust in turn, on a collective basis, on an aggregated basis, invest in shares of the company. So mutual fund per se, the value which is derived is because of the underlying investment, which is shares of the company. But what you transfer under the legal form is nothing but the units of mutual fund. That's where the first question comes up is whether this mutual fund is covered within the term shares or not. Now, since those are not shares as defined under the provisions of Companies Act, those do not fall within the catch-all provisions and are excluded. Therefore, you go to the residuary provisions of the tax treaty, and most of the residuary provision which says that if it is property other than shares, the right to tax is with the country of your residence. That means the residence from where the NRI is investing into India and not India per se. Let us look at some of the popular treaty where this conclusion gets reinforced. We have got India-UAE treaty, which gives India taxing right only in respect of shares of the company. Similar is India-Singapore treaty, where again the rights are limited to shares of the company. Similar is also the case of Swiss treaty, that means Switzerland with India, where the taxing right to India is limited, only confined to shares of the company, and even such is the case of Australia. So friend, a large part of Indian diasporas who reside in those countries may avail the benefit of the tax treaty and claim non-taxability of this particular provisions. Of course, the ground rule continues. When you are availing a tax treaty, you need to have a tax residence certificate, you need to have digital form 10F, and you also need to prove that your residence or your stay in that country is not for any tax avoidance purposes, but you are genuinely staying there and residing in those countries. Please note that conclusion is not same for all the cases. As each individual is different, even each texture of treaties are different. Now, if the treaties, that means your residence is say in countries like USA or in countries like Canada, the beneficial provisions are not available. The tax treaties with those countries typically says that if any capital gain arises to a resident of a contracting state, that means USA or Canada, then in that case, the right to tax is with India. So unlike other treaties where right to shares was only given to India, your entire right of capital gains is given to India, and accordingly those income will be chargeable to tax. There are some precedents, there are some tribunal decisions which reinforces this. We have got a Cochin tribunal decision, we have got Mumbai tribunal and Delhi tribunal decision which has agreed to this conclusion. This is important, especially in the financial year of FY 24-25, where the diasporas or the NRIs are likely to file their tax return. This position may be considered. Of course, the position is subject to litigation, and hence a cost-benefit analysis is always advisable. Another instrument which is making news is the taxability of derivatives. Now, we have some media reports which suggest that that tax officers or the tax authorities are proposing to tax the derivative income earned by FIIs. Now, these are traditionally India and Mauritius treaties as the base case. Now, what are derivatives? Derivatives may be options and futures. Those are contract based on which the value of that instrument, a future or an option, is derived underlying from the shares of the company. The larger question here is taxing right, which is confined only to shares, can also expand to the derivatives? Or derivatives is a separate instrument different from shares, and accordingly it falls within the residuary provisions. Fortunately here we have some precedents available. Now one will recall that India-Mauritius Treaty undertook or underwent a particular amendment. This amendment was effective from 1st April 2017. Erstwhile, Mauritius had right to tax entire capital gain, be it shares or anything else, and hence this controversy had little relevance. Fortunately, when the treaty was negotiated, we have the then Revenue Secretary, the distinguished Shashikanta Das, who also serves distinguished position within the government, came up with a press release or a clarification to the media, where he specifically stated that the amendment will only hit shares of the company which are acquired after 1st April 2017 and does not cover instruments like compulsorily convertible debentures and derivatives. Now this clarification is coming from a high office who were involved in treaty negotiations. In my view, this should have ended the litigation rather than giving rise to an unconfronted or unwarranted litigation. I would strongly believe the principles of Bhagavad Gita may have its own place. It is stated there, whatever happens, accept it, learn from it, and move on. The ghost of Mauritius Treaty in respect of shares acquired before 31st March 2017 or the instruments where clarifications is huge enough should not come again on the surface again and again. It does not help the community or an investor who relies upon circulars which were issued by CBDT, which was approved by Supreme Court in terms of Vodafone and Azadi Bachao Andolan, where again the same question is set into them that in spite of you having a TRC, in spite of you being resident of Mauritius and Singapore, prove that you are entitled to treaty benefit. As it stands true in life, one should always move on. In this case, fortunately, there is another decision of Mumbai Tribunal in case of Vanguard, where the tribunal is very clear, unequivocal to state that derivatives derives its value from shares of the company. It is true. But shares and derivative per se are different instruments, and accordingly, income arising from derivatives is not taxable in India. We deal with one more nature of instrument, which is compulsorily convertible debentures. Now here, the principle of form versus substance may come into play. It is typical where we see large institutional investors or large private equity house who infuse CCD into the company rather than equity. There may be various commercial reasons. The purpose may not be to increase the equity base or classify themselves as one of the shareholders, given there is a peculiar liabilities, or in terms of the liquidation waterfall, equity shareholders are at the last. But the terms of instrument should be looked into detail as to what are the rights which these holders are getting. Is it equal to what is being given to the equity shareholders? On first principles, what we have is provisions of Companies Act Section 230, which specifically define debenture to include debenture stocks, bonds, or any other instrument of the company evidencing a debt. Applying that same principle, CCD would become debt and not shares of a company, and therefore the taxing right will not be available with India. We have number of laws which come into the picture. Now here we have Section 58 of Insolvency Code, which defines the financial debt instrument to mean any amount raised pursuant to any note, purchase facility, or issuance of bond. A question came up before Supreme Court in a context of an IBC law in case of IFCI Limited, where the question was whether CCD can be categorized as equity or they will fall within the financial debt. Supreme Court stated that since there is no obligation of repayment by the debtor, because of that facet and the terms of instrument, it will qualify as equity. There are a number of precedents under the provisions of Income Tax Act, and we all, after a point, are historians. We all study history, we all study principles in certain contexts and apply those principles or ratios to the problem statement under consideration. Now friends, you will remember that a debated topic is whether interest on CCD, which you pay prior to the conversion, qualifies as deduction under section 36(1)(3). We have some host of decisions which stated that CCD until converted into equity are debt and interest on debt merits deduction under the provisions of 36(1)(3). Similar is the debate whether expenses incurred on issuance of CCD, can it be allowable as a revenue deduction or a capital deduction. Courts have held that because CCD represents debt, those expenses incurred are eligible as a revenue deduction. We also have provisions of section 94B, which defines debt to mean any loan, financial instrument, finance lease, financial derivative, or any other arrangement which gives rise to interest, discount, or other finance charges that are deductible in computation of income chargeable under the head profits and gains. Applying the provisions, one can still make a view that CCD represents debt and it is not covered by shares of the company. Through this podcast, we covered certain instruments. Users will have to apply their own discretion and take appropriate positions. I am extremely thankful to each one of you who have joined me in this entire course of this podcast, and I look forward to your feedback, comments. Your comments makes us stronger. Your feedback encourages us to do more. Thank you very much for joining us.